Today, you open your trading app and check the trade you placed 3 days ago. The stock did exactly what you said it would do. You called the direction, you were right, and the trade is still losing money. You refresh the screen, nothing changes. Price is up, account is down. So what happened? The honest answer is more uncomfortable than being wrong about direction. You weren't beaten by the market. You were beaten by time. You bought a call option, the right to buy a stock at a fixed price, called the strike, before a certain date. Part of what you paid is intrinsic value. The real part, dollar for dollar above your strike. The other part is extrinsic value, the price of possibility, what the market charges for time and uncertainty. Extrinsic value decays every single day, automatically, whether the stock moves or not. This is theta decay. Think of it as rent you pay the market for time. So even as your stock climbed, that rent was draining your option the entire way up. There's a second force, even less visible. Implied volatility, or IV, is the market's estimate of how much a stock will move, baked into the option's price. Not direction, motion. If you buy when IV is high and the stock moves your way, but volatility then drops, the option can still lose value. This is IV crush, and it hits hardest around earnings when uncertainty is priced sky high right before it resolves. Right about direction, still losing to time and volatility. Direction was never the only force in the room. So what's the alternative? Instead of buying one option and hoping decay stays out of your way, you buy one option and sell another. Same expiration, different strike. That's a debit spread. You pay a net cost, but the option you sold offsets part of your premium and caps both your loss and your gain. Picture a stock at $100. You buy the 100 call, sell the 110 call. Max loss is locked the moment you open it, whatever you paid, net. Max gain is capped too, the $10 width minus your cost. Floor and ceiling, pre-negotiated before the trade begins. You're still long one option decaying against you, but now you're also short one decaying in your favor. Two forces pulling against each other instead of one draining you alone. This is the quieter side of options trading. No promise of turning 500 into 50,000 overnight. Just a structure where you can be right more often because your trade isn't fighting two invisible forces at once. Small, repeatable, defined risk wins. Capital recycled. Losses treated as a planned cost, not a catastrophe. There's real research behind this. Behavioral finance researchers Brad Barber and Terence O'Dean found that the most active traders dramatically underperform calmer, more disciplined ones, largely from overtrading and overconfidence. And the math underneath all of this isn't new. The Black-Scholes model, developed in the early 1970s, prices an option using the stock price, the strike, time remaining, volatility, and interest rates. Time and volatility aren't side notes, they're load-bearing. The VIX, the market's so-called fear gauge, is the tradable proof, spiking whenever uncertainty itself gets repriced. Think about earnings season. IV climbs for days before the report, pricing in a binary, unpredictable event. A trader who buys a call right before that report pays full price for that uncertainty. The news comes out decent, the stock pops 2%. But the uncertainty just resolved, so IV collapses within minutes, erasing the gain in the same breath the stock is rising. Right prediction, failed structure. A defined risk spread doesn't erase that risk, but it changes your relationship to it. Part of the position is short an option too, so some of that same collapse works for you. The max loss was known before the report even came out, which means the size was something you could actually live with. So go back to that screen. Stock up, account down. Not a glitch. The system working exactly as designed, just not the system most beginners think they're trading. Before your next trade, ask a better question than which direction. Ask what time is doing to this position between now and expiration. Ask what IV is pricing in and what happens once that event resolves. Ask whether a defined risk structure exists where direction isn't the only way to win. Because the real reason your winning trade lost money was never about the chart. It was about everything the chart wasn't showing you.